The government is set to invite financial bids for IDBI Bank soon as talks on the share purchase agreement with potential bidders near a close. The move comes on the back of Finance Minister Nirmala Sitharaman indicating a completion of the deal in FY26.
Torrent Pharma will buy out KKR's 46% stake and make an offer to employees and minority stakeholders of JB Chem in an over 19,000 crore rupee deal, followed by the merger of the company. Analysts give the deal a fairly valued thumbs up.
The deadline for IndusInd Bank to send its recommendations for the CEO position to RBI ends today. Sources tell CNBC-TV18 Rajiv Anand of Axis Bank, Rahul Shukla of HDFC Bank and Anup Saha of Bajaj Finance may be named in the list.
Hope of an early US trade deal rises after Donald Trump says a very big deal with India may be possible soon. Indian trade negotiators visiting the US extend their stay, giving them more hope and legs.
Hello and welcome to a halftime report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Manglam Balu. Well, it is turning out to be a day where we are starting the week rather on a little bit of a cautious and mixed note. So we have the mid-cap index, which is outperforming with a gain of around 0.5%. But we have the Nifty as well as the Sensex just about consolidating with a negative bias after what was a strong week last week. So the Nifty just about lower by around 68 points. The Sensex lost around 250 odd points and the Bank Nifty absolutely flat at this point in time. But a lot of deal action. So whether it's from the paint space or whether it's from the pharmaceutical space, Manglam.
A lot of deal action. That's exactly what's taking place. But, you know, the street would like the Nifty consolidating a little bit. The broader markets are doing a lot better. We have, a bunch of stocks advancing as against the number of stocks which are declining. The crisscross lines haven't crissed or crossed. We have more stocks in the green than, they've been through the course of this trading session so far. And the mid-cap index has definitely moved to the high point of trade, telling you that the street is betting for an important support coming in for the frontline index, even as it consolidates after a big rally. But speaking about deals, one of the many that took place over the weekend, we had Rainbow Medicare. That's the first management on the show. They will buy 76% stake in Prasanthi Hospital in Telangana. To talk more about this development, we are now joined by Ramesh Kancharla, who's the chairman and managing director of the company. Thanks a lot, Mr. Kancharla, for joining in. Every time you join in, we ask you about this inorganic plan, right? This has happened. Tell us a little more. How much can you scale this by? And by when does this break even? Or what synergies are you expecting?
So this is the first expansion within the Telangana from Hyderabad. We have done it. So Warangal is the second largest, the Tri-City, Warangal, Hanmukonda and Kajipet. It's about 1.1 million population. So where the brand is a very well recognized. So we've been looking at kind of opportunities to kind of start a hospital there. This has come very handy, Prasanthi Hospital, and also fundamentals are very similar. It's a dominantly kind of obstetric-driven hospital as of now, and the neonatal. So where we can go in kind of build further to be a comprehensive children's and women's hospital.
Okay. So could you just give us a sense in terms of what presence you all would have in Telangana now with this particular acquisition? How many beds would you all have and the statistics such as occupancy that you are probably anticipating?
I think that this is a 100-bed facility, and with this addition, we have 940 beds in Hyderabad. So this will take us get past 1,000 beds in Hyderabad and Telangana. So, this 100 beds at the moment, their occupancies are kind of somewhere around 30+%. So we're hoping to kind of build a kind of a larger fort over there and have a kind of a comprehensive services for the women and children.
So this current hospital, Prasanthi, which you've acquired, has occupancies of around 30-odd%.
Yes, that's right. Yeah.
So that's quite low. What is the financials looking like? For example, the EBITDA as well as, say, the bottom line. Is it making money?
It's about, the 17% of EBITDA, and they do good numbers, actually, numbers-wise, when you look at it. They do 1,400 deliveries. They see about 4,500 outpatients, inpatients, about 30,000 of outpatients. I think what's important is that it's been driven dominantly with an obstetric-driven hospital with a neonatal care. So what Rainbow is going to make it more comprehensive.
Mr. Kancharla, I wanted to understand if there is expansion plans beyond this 100 bed that you have out there. Do they have room for you to add some more beds there? Would you have to invest a little more out there? And since you take this hospital over, what is the kind of incremental revenue and EBITDA that we can see? Because you're a much bigger chain. So there would obviously be some sort of cost synergies as well.
Yeah. So traditionally, what we look at it, we would term it as a regional spoke. As a regional spoke, 100 beds is fairly good enough. Probably what we would do is we would tweak a little more towards more intensive care beds, plus obstetrics and then pediatrics. So we drive a specialty care from the clinics from Hyderabad, and also other complex stuff will get transferred to Hyderabad. This will be a typical regional spoke. The 100 beds is fairly good enough. Probably we need to do a more capex as we move forward, as our hospital's operations are getting strengthened.
Okay. Just wanted to, ask you whether you're looking inwards into the domestic business more because of, say, the international revenue being a little challenging. We do understand that, Bangladesh, Oman, Kenya, Sudan, there was a significant decline in a couple of these countries in the past quarters. Are you now looking at domestic revenue more strategically?
I think the international business has never been the big business. I think we maximally clocked about year before 3.5%. Last year, it's dipped down because of geopolitical reasons. So that is that's a long haul. Focusing on international business will happen over a period of time. So that has nothing to do with this one. This is a strengthening our position in Telangana state, because this is where the brand is very well known, even into the village level.
Hear of any more similar deals in other geographies as well in the very near future?
Yes, we are working on a few. Probably will come back to you very soon.
And they will be of similar size itself, right?
Probably larger.
Larger. And how many do you expect to close in this year?
Well, we'll come back to you very soon.
Okay, let's put it this way. How many are you in talks with right now?
No, we explore everything. Whatever is available in the market, we would explore it. But eventually, we see that what suits to us philosophically, and also where we can kind of build further on.
So would it be this size of an acquisition, and would it be in, the gynecology segment itself?
Yeah, this will be within the pediatrics and obstetrics domain itself. I don't think we would be kind of moving away from our core business.
And geography? Will it be this one, or are the other geographies that you're exploring? Because I remember...
Different geography, which we will...
You focused a lot on the West earlier. Is the next one coming in the West?
I'm not sure, so let's wait for it.
All right.
Just before we let you go, just a quick question, sir. Just wanted to get a sense in terms of the pickup this quarter, because last quarter you said was unusually quiet for you all. Just a quick one-word answer in terms of what you're probably tracking this quarter as compared to the last.
So we're going to come with the results very soon. So let's wait for the results. We're almost in the fag end of the quarter.
Okay. All right, so we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Rainbow Medicare. The stock is up around 1% odd. Small acquisition that they've made of around 24 odd crores of a particular 100-bed hospital in Telangana. We'll take a short break. Up next, we'll focus on the big deal. Torrent Pharma JB Chemicals, one of the largest deals in the India branded pharma space. More on that once we're back.
Welcome back. The big deal, that's what everyone's going to talk about, right? That is the one that has come in the pharmaceutical space, where Torrent Pharma has gone ahead and bought JB Chemical and Pharma. In doing so, it's actually become a big conglomerate over the last, few years, not only in the pharmaceutical space, but power space, and also having interest in Gujarat Titans. But for Torrent Pharma for now, Ekta has moved across to the big wall. Ekta, tell us more about this deal.
Well, yes, Torrent Pharma has announced a two-phase acquisition of JB Chemicals from KKR, marking one of the largest deals in India's branded pharma space since possibly the Ranbaxy-Sun merger. Torrent will first acquire 46.39% stake for around 11,917 crores and may pick up an additional 2.8% from JB Chemical employees at around 1,600 rupees per share. An open offer for 26% follows at around 1,639 rupees per share, with the total size of the acquisition for Torrent possibly going up to as much as 19,480 odd crores. Now, in the second phase, the companies will merge, with JB shareholders receiving 51 Torrent shares for every 100 held. Now, the deal values JB Chemicals at around 25,689 crores and 11% discount to its closing price ahead of the deal. With the JB Chemicals acquisition, Torrent Pharma is now poised to rise from the 6th to the 4th largest pharma company in India. The deal, in fact, is expected to boost its domestic revenues by 35%, surpassing 8,600 crores based on FY25 numbers. Torrent will strengthen its dominance in cardiac and gastro segments, gaining top brands like cardiac drug Cilacar with sales of 785 crores and gastro drug Metrogyl at around 342 crores in terms of a size of a drug. It also secures entry into ophthalmology and expands its footprint in the global CDMO space. Torrent Pharma may in fact fund the JB Chemicals acquisition through a mix of internal accruals, debt and equity via QIP. It could take on as much as 10,000 to 12,500 crores of debt, pushing the combined net debt to around 14,500 crores and a net debt to EBITDA to around 3 times on an FY25 basis, according to analysts. However, analysts including DAM Capital are not overly concerned. They point to Torrent's steady free cash flows and believe a 2 times EV to EBITDA leverage is reasonable and the debt could be paid down in 3 to 4 years. Now, while JB Chemicals currently operates at a lower EBITDA margin than Torrent Pharma, analysts are not overly concerned about that either. Torrent has had a strong track record of cost rationalization as seen in its past acquisitions of Elder, Unichem and Curatio, which saw margin expansions within 1 to 2 years. While we could see near-term dilution, analysts believe the combined entity could target EBITDA margins of 34 to 35% over the next 3 to 4 years. Lastly, what are the brokerages saying? IIFL recommends JB shareholders should avoid tendering in the open offer and wait to swap their shares in the merger. Nomura expects the adjusted EPS accretion in the mid-single to low double digits. They maintain a neutral rating with a target price of 3580. HSBC expects the deal to be 3% accretive to FY27 estimated EPS estimates. They retain a buy with a target price of 3,775.
All right, Ekta, thanks a lot for that. So that is the big pharmaceutical deal that took place over the weekend and the sum and substance of it all, as explained by Ekta. So to talk more about this, we do have Sumit Gupta, AVP Research at Centrum, and Suresh Subramaniam, who's a partner and National Life Science and leader at EY. Let's go to EY first. You know, when we look at this deal, we look at deals of this size, typically analysts assume a 500 to 600 crore sort of cost synergy that has come by. As someone who's been looking at this M&A space, specifically of this deal, what would you suggest would be the cost synergies here between the two players?
I think there are tremendous potential for cost synergies. We can't kind of actually guess or put a number to it as to how much it would be above 600 crores. But it might be suffice to say that there are a lot of areas where the synergies can play out. One is in increasing capacity. You can do more with less. The JB Chemicals has 8 manufacturing sites. Combine it with the 16 manufacturing. Combine it with the manufacturing sites of Torrent. Your ability to serve in terms of capacity to the global markets is very high. And if you look at the portfolios, the portfolio synergy is very high. It is both complementary and consolidating. So again, there is a huge play of synergy. There's a lot of scope for cross-sell. And I think all these will kind of impact the synergy number that you put out.
Okay. All right. Suresh, just wanted to ask you about the possibility of how Torrent itself is growing, because they've jumped from 6th to 4th. They've made a string of acquisitions in the past couple of years. What do you think, the strategy for a Torrent Pharma would be in the domestic market? Are they going to become a force to reckon with?
Yeah. So, you're right. When you look at their past acquisitions of Elder Pharmaceuticals, and subsequently Curatio, the smaller ones, they've always kind of enhanced their brands they acquired, be it Shelcal or be it the Derma brand from Curatio. So I think given by the potential of the big brands that are there, Nicardia, Metrogyl, Silacar, and Rantac, which are both in the gastro and the cardiovascular area, as you alluded a while ago, there is tremendous potential to kind of get into the Torrent outreach, and there is a scope of growing these mega brands, right? And these are very big brands. So that's one thing for sure. So the second one is very clearly in the area of tier 2. Tier 2 areas, Torrent has a very big reach, about 8,500 field force, or probably 9,000. And juxtapose it with, the JB Chemicals field force, which was probably 2,500 or so. There is a tremendous scope to kind of penetrate markets with these big brands and the augmented portfolios, if you may. The next piece is also to kind of play a bigger role in the OTC market. Given their manufacturing capability through their CDMOs, their ability to serve their OTC aspirations are much bigger now. So sure. I think what we're seeing is a rapid movement, because these are two companies growing at above 12%, and you can expect a much higher growth through the synergies.
Sure. Sumit, I just wanted to narrow down on what you would be recommending, say, to your clients if in case they do have JB Chemical shares. Do you tender in the open offer? Do you stay put for the share swap?
Offer, so just stay put with the Torrent share, so JB Chem share. So basically, I see more synergies going on, and once the merger finalizes, then it will be beneficial from the shareholder point of view. As of now, one should not tender.
All right, that's the view. Just hang in there, gentlemen, because the bottom of your screen, there was a clarification that is coming from Reliance, where they've gone ahead and denied any information with regards to the sale of Naira Energy to Rosneft. This morning, the stock was doing fairly well on account of reports. There was a PTI report on talks to buy Rosneft's stake in Naira Energy. Reliance Industries has gone ahead and denied that. The stock has been doing fairly well over the last 10 days or so, has recovered a strong bit from the lows, and has been one of those, supporters of the Nifty as it's moved higher. But right now, it's flattened out on the denial of the PTI report of talks to buy Rosneft's stake in Naira Energy. So that's the big corporate development that has come in on Reliance. But Sumit, you're saying that people should not tender in the open offer. From your model, if you track both the companies, I wanted to understand how long before this deal becomes EPS accretive for Torrent Pharma, and what are the kind of revenue and cost synergies that you're penciling in? Suresh said it could be between 500 to 600 crores. Without giving a specific number, could perhaps be more than that as well. What are you factoring in here?
Yeah, so basically it will be, as of now, for the near term, 1 to 2 years, we are expecting EPS dilution of around 5 to 6%. However, it depends on how the deal structure would be done. So if it is all debt, then it would be more EPS dilutive. However, if there is equity and a mix of debt, then it would be EPS accretive in the first 2-3 years only. So it depends on how the deal is going to be structured. So we need clarity on that.
Okay. And on synergies, cost synergies, 500 to 600 crores, is that a fair estimate?
So, yeah, cost synergies would be there. So with respect to Torrent, obviously in the first few years, 1 or 2 years, basically I'm expecting around 100 bips kind of decline in Torrent's margins from 33 to 32. So basically it's nothing significantly detrimental to Torrents, but overall over the medium to long term, it would be very much beneficial from Torrent from combined entity point of view also. And
Okay.
if we see Torrent's acquisition of Kuroshi also, it has a historical track record of turning around the businesses. So I'm positive on Torrent's execution. So they can also give JV Chemical margins a flip over the next 3 to 4 years.
Okay, so just Sumit, just on the debt that Torrent will be taking on, ranges are 10,000 crores to almost around 12,500 crores. The consolidated debt could be around 14,500 crores on the books for the two entities. How concerning is that for you?
Not that concerning. As of now, Torrent's net debt to EBITDA is basically 0.6 times. However, suppose if it goes to all debt deal also, in that case, it would be around 2.5 to 3x. However, I'm expecting a mix of debt and equity. In that case, it would be around 1.2, 1.3 times, which is very much comfortable.
Okay, Suresh, what about you? The overall deal structure, for example, we don't know the combination right now in terms of equity and debt, but the fact is that there will be a huge debt component which Torrent will have to take on. Do you think that they are probably going to be able to service it more easily, and what would the past acquisitions tell you?
I think they've managed their past acquisitions and they've managed to, get better EBITDAs around cost synergies around in both the Elder, the Curatio deals, and the way they've integrated the company and kind of made brands more profitable, I think indicates that they can pull out more money from their operating cash flows. And so I think it's a good story. The debt is manageable. They have a track record of doing that. And besides, I think global markets is something that we should not discount. They've kind of, if you really see, Torrent is strong in US, Germany, and Brazil. And, what JB Chemicals brings in is, while it brings in consolidation of US, it kind of brings in, Russia, South Africa, and a whole lot of emerging markets. So their ability to get more out of their portfolio, globally be able to cross-sell on their portfolio will be of a higher magnitude. All that encourages me to think that the revenue they generate and the profitability that they already have would enable them to kind of service their debt much more easily.
Suresh, Sumit, thank you so much for joining in and giving us your perspective on this big deal. What we'll do is take a short break, come back. On the other side, we get you more of the markets and a lot of other stock-specific action, which is currently underway. The Nifty bank is just about moved into the green as we speak.
Welcome back, and joining us now is Rahul Kapoor. He's Vice President, Head of Shipping Analytics and Research at S&P Global Commodities Insights. Rahul, hi, thank you so much for joining in. And shipping clearly has been a place to be for the last couple of years now, where after Red Sea, it's about Strait of Hormuz now. While we do understand that there are no concerns within the voyages there, but would you say there have been some restrictive actions taken by some companies? How have you seen the number of ships? Because the last time I kept account, 100 to 120 ships pass every day via that area.
Yeah, certainly. Thanks, Manisha. Good to be back. I think if you go back just a few weeks, right, I think Strait of Hormuz has always been in the focus, right? Its dependency for the top Asian buyers and what it means for the global oil flows, LNG flows, right? Right at the time of the escalations, we did see a bit of a pause on the traffic. But overall, if you look at particularly the tanker transits, right, as well as other ships, they have been robust. We haven't seen material decline in terms of the shipments across Strait of Hormuz, the oil flows as well. There were some interferences, particularly with what was happening with the GPS as well as the AIS. But overall, I think there is calm returning. But the fact is freight rates are still up, right? The freight rates, particularly for the tanker markets, effectively doubled in that short period of time. You have higher insurance premium. There's war risk premium as well. That will take its own time to come off because there's still some concern. But overall, shipments and transits have been particularly fine.
Just to get a sense of the freight rates, really, they did double. They've come off slightly a bit of as well. On a year-on-year basis, how would you look at those numbers?
Yeah, so I think if you just go back before the conflict started, for the big VLCCs, the very large crude carriers, the freight rates were around $20,000 to $25,000 per day. They went all the way to $70,000 to $80,000 per day. There were certain ships which were fixed even for $100,000 per day, close to that, right? We are somewhere in 50 to 60 now. We haven't come off totally because, like I said, there's still some concern, as well as these are over a period of time when that risk goes off completely, the freight rates would start coming off, right? Oil prices have certainly corrected, but the freights haven't fallen to the levels before pre-conflict.
Rahul, when you look at the crude oil prices, when you talk about that, it is said that it is 80% geopolitics, and the way geopolitics has been right now really seems to be making prices very, very volatile. How would you read into the geopolitics from where they stand? Would you say it's eased off considerably? Have we seen all of that premium go over?
Yeah, I think particularly for the oil prices, that has certainly come off. But like I said, if you look at just the global trade, or for that matter, global shipping, right, geopolitics is playing a much larger role. We've seen from the Red Sea, there's still, as in terms of the attacks on the merchant shipping, those have come off in 2025. But the shipping companies certainly haven't gone back en masse to the Red Sea. We're seeing some opportunistic traders as well as operators, particularly for the tanker shipping, go back to the Red Sea. But the Suez Canal, for that matter, Red Sea is still not to the levels where it was pre-conflict, right? Same on the Hormuz as well. Like I said, on the oil prices, the premium might have come off, but it hasn't come off fully on the freight rate side. So geopolitics is still very, very central to what's happening with global trade and global shipping at the moment.
Rahul, and geopolitics is one part of it yet again, because you have tariffs and sanctions and compliances. I mean, there's no end to that story.
Yes, indeed. Yeah. Yeah, I think that's something which we've been highlighting, right? If you see, and we have to give we have to give credit to global supply chains as well as shipping, because if you look at the last 5 years, we've had COVID-19, we've had Panama Canal drought, we've had Suez Canal, in the Red Sea situation, we have Russia-Ukraine conflict, right? But the supply chains have been resilient, and shipping industry, for that matter, has been supplying goods to all of us, right? So I think that's important as well. But again, coming back to it, like I said, geopolitics is now essential to global trade, your tariffs as well. And that forms our view that you will continue to see global trade come off, right? This year as well, we are expecting flat to slightly negative growth in terms of global trade, whereas your global trade, your global GDP still continues to grow. So overall, global trade to GDP continues to compress, right? That's a long-term phenomenon which we're talking about, primarily because of what's happening with geopolitics and protectionism rising.
And Rahul, with that as a background, would you say investment and capital flows get impacted within the sector?
No, I don't hear anything.
Rahul, do you think with all of that happening, there could be an impact on the investment within the sector? All right, looks like we've lost Rahul there, but interesting points he was making, saying that when it comes to freight rates, well, we did see it going from 25 to 80 and coming back now at 50 to 60. So clearly way, way higher than where it was before the Israel-Iran conflict started. And another interesting thing that he said was that it is a very flat global trade growth that we're looking at, not at all aligning with what the GDP growth looks like in the global markets. So this is a sector to keep an eye on. Interesting to get a conversation going on what really is seen in sense of investment and capex there. But that's for another time, looks like, guys.
We'll take that on board, Manisha. Thanks a lot for that. And most importantly, look out for the impact of this and the results of all these shipping companies as well, whether they reflect this time around or not. Before we take that short break, pull up Angel One. That stock has moved to the high point of trade. And by and large, the mid-cap's doing a lot better. What we'll do is take a short break, get you updates from the F&O on the other side. Welcome back. Let's take a look at the F&O setup during the day, and it's not particularly bad. Why do I say that? Because the frontline indices are consolidating, absolutely flat for the Nifty, bank filling between red and green. The Nifty's giving up just a smidge of the gains that it had made all of last week. And the broader markets, they are doing very well. So the mid-cap and the small-cap indices come up for you. Way more stocks advancing than the number of stocks which are declining. So all of this sets us up for maybe a pause and thereafter an up move. Why do I also say that? Because, on Friday, we had a couple of indicators that suggested maybe the market was overheating a little bit. Those indicators were, one, the India VIX. That had fallen to levels of 12.4. And this morning we pointed out that maybe it's factoring in complacency. That's coming back to normalized levels. And secondly, the put-call ratio typically moves from 1.2 to 1.3. That's the overheated zone. It's now cooled off to close to 0.94 or 95. And that's, telling you that, okay, bulls are making some room for a further up move after this pause for breath. What are the active options? 25,600 call, fairly active. 25,650 call, equally active as well. So 25,650 call has a premium of almost 100 rupees. At the lower level, we are seeing 25,600 put, seeing a fair amount of writing. And at the high level, 25,800 call too sees some writing at a premium of 50 rupees. What does all of this data mean in terms of levels? Well, strong support seen around 25,450 to 25,500. That's where we are, closer to 25,550 thereabouts. And congestion between 25,750 and 25,850. Two stocks I'm watching out for. A lot of long positions added on LIC. Life insurance companies have done well in the first half of this year, calendar year so far, and LIC sees some fresh bidding. And RBL Bank may be the first stock to enter the F&O ban in the July series. So we'll keep an eye out on that one. That's about the market. Take a short break. On the other side, we have the management of Zydus Wellness joining in on demand trends and their FY26 outlook. Welcome back. Zydus Wellness, the management usually does not speak much, but over the last 2 weeks or so, the stock has been on our radar on account of a large trade that took place. We had, TPG Capital Investment arm selling about 7.5% stake. On the buying side was PPFAS, Parag Parikh Mutual Fund, which bought about 7.3% stake at 1,900 rupees a piece. Since then, seen a rally of almost 7-8% or itself. The company joined us post their fourth quarter numbers, said that they are targeting early teens revenue growth in FY26. with a margin glide path of 17 to 18% in the next couple of years as well. Tarun joins in now to talk more about this. Tarun Arora, obviously the CEO and director at the company. Tarun, always a pleasure speaking with you. We'll speak about the long term, the medium term, the aspirations of the company. But here, in the near term, can you tell us a little about the underlying consumer sentiment? Have we seen any improvement from the last time to now? There have been rains, but also there have been unseasonal rains, which may impact some of your prickly heat powder business.
So, Manglam, always a pleasure to talk to you and be on CNBC. So thank you for having me here. I think this summer's been brutal for anyone who has a, summer business. And we have not one, but two brands, both Glucon-D and ISIL, which rely heavily on this. So it's actually gone worse. And typically in between rain, you're prepared and you do expect some bit of surprises. But there it is. Has been a continuous rain throughout the quarter, throughout the last few months. So obviously it has impacted a lot of our momentum in these two brands. Everything else stays on track, largely in line with what our expectation and plans were. So, it's bittersweet in a way because we've had good traction on some of our initiatives, new products. Our acquisition, Max Protein, has seen a good traction. It's in the right space. Some of the large, high momentum and summer spaces have really pulled us down. So very happy with Everyuth. When I look at Everyuth, Neutralite, when I look at, products like Max Protein, even a sugar-free Delight range. But things that's what it is.
Tarun,
Yes.
if you could give us a sense in terms of how much these two brands have been impacted. If you have to compare, say, the performance last summer to this summer or the average performance, how much is it lower by?
So, sitting on 30th June, I'll avoid getting into numbers. But I can tell you it's been brutal. It's been worse than we would have imagined. And therefore, I would say that there is always situation when there is off-season rain and you kind of deal with it. It catches up and there is a momentum. But here it has been non-stop. So obviously the impact on these two brands have been significant. And leave it at that. we hope that the remaining 3 quarters will hold us in good stead and help us catch up on the numbers that we wish.
So the early teens revenue growth guidance that you've given for this year, does that stand at risk because of what the first quarter was like?
So, look, my view always remains that we'll be a double-digit growth over a medium term, and therefore we retain that view from a medium term. For this year, like last time I spoke, and the numbers change every day. So I think rather than me commenting on if that number changes, we'll have the numbers once we publish it. But our focus remains to execute consistently, and whatever we lose this quarter, we will try pretty hard to recover through the next few quarters. But that's why
Just from a bookkeeping standpoint, how much do Glucon-D and Nycil account for in your overall annual business?
We don't specifically share brand-wise numbers, but their largest share of numbers happen between Q4 and Q1. Almost 85-90% of the business happens between these 2 quarters. So therefore, there's a big chunk sitting for these two brands.
Let's talk about a larger trend then, Tarun, because you had indicated that the rural markets have been outperforming for you all as compared to the urban segments. Is that trend still playing out, and by how much of a margin? And do you expect that trend to play out? If you could just give us more details.
Sure. So I've seen over last financial year and even continuing trend, if I really look at it, rural has been 3 to 4% as reported by all syndicated data, been growing faster than the urban. Of course, urban gets compensated because when I look at sources like Nielsen, they do not cover the quick commerce. So it gets compensated. But from a consistency and a general trade point of view, rural has been always leading. Even our distribution is substantially, disproportionate to the share of sales. So 25% kind of sales coming from revenue coming from rural, but almost 50-50 share between equivalent presence in our distribution for rural and urban. So clearly we are prepared for a larger growth in rural, and it's consistently done. Urban, I'm hoping that post this, current actions that the government has done, they've action on tax, the interest levels have been lower, some level of urban momentum will catch up. The good thing is, I do see some categories still showing a good urban momentum, some premium spaces, newer building spaces. So that can really keep us doing well in urban as well.
Got that. The only problem is that the contribution of those are not as much to drive the entire bus forward. They're just enough to, spur near-term growth. Just wanted to understand about the MFD category, right? Because milk prices have increased, and typically when that happens, categories such as Bonvita, Horlicks, Boost, Complan, all of them see a bit of a downtake. Add to that, you've also very recently had a leadership change in HUL, where the foods business has a new leader with a view to grow Boost and Horlicks. So there is strong competition, a new leader among the competition places, and higher milk prices. In light of that, what's the prognosis for Complan?
Sure. So first of all, I think if they manage to grow the category, because first of all, I think we need to recognize there's a category level issue. And a market leader with 50-55% market share, if they drive the momentum forward, I think it'll be good for everyone. So I really hope that they succeed in what they're wanting to do. So I'm less worried about competitive action, but I'm more positive. I'll be more positive if the category really shows a higher momentum and if they are able to do that. So I'm completely with any actions they take, which is category building. Having said this, for us, I do recognize that there are opportunities for Complan to fight against the challenge that we face at a larger level, environmental level. And therefore, we are trying to place newer SKUs, newer, need spaces, which Complan never serviced. For example, the last year, about 8-10 months back, we launched an adult nutrition VMAX. We also have a Complan NutriGo, which we'll try and rework and build it forward better for the future, which is in the toddler space. There may be a couple of more ideas over next 3 quarters that we will explore. We have it in the pipeline. We'll just take a call basis of how the market shapes up. If we could help launch those as well. So my view is that, one, I would hope that the leader really moves the market in this tough environment where the milk prices are going up. There is other alternatives which are driving forward. While we do that and we'll wait for them to act on it, we are looking at segments or need spaces where Complan has opportunities, and we're building around those. So as the market moves up, we could move even faster as we build around.
Okay.
There's also an opportunity around clean labels, which we'll consider across our portfolio as consumers are getting more and more conscious about some of those things.
Okay. Tarun, you join us on a day where there's a huge deal which has taken place in the pharmaceutical space, and that has many OTC brands. It just reminded me of the Heinz India acquisition, which took place in 2019 by all, and that was worth around 4,500, 4,600 odd crores. Just give us a sense in terms of what the M&A strategy would look like for the company going forward. Any such big transactions on the cards? What would be the cash on books which you would be ready to deploy?
So first of all, I think we've clearly M&A has been part of the strategy at Zydus Group and Zydus Wellness itself. It allows us to one side scale, which is what Heinz deal did, but also play in spaces that we want to, which is food and nutrition on one side and skincare on the other side. We do believe there are spaces where we can build further and add to the our portfolio in the right direction. Food and nutrition, which is already a much larger part of our portfolio, we are very, very keen that we can continue to add, and that's why this Right Bite deal happened, where we have Max Protein, which is really helping us build and play the protein part very well. We do believe there are spaces like VMS, which we could increase. There are some health food opportunities we are looking at. There are also skincare spaces. And third, which we look at is increasing our footprint beyond India, which will help us play a much larger game. And last, fourth, which I would say that we evaluate is from a D2C or a online space, which gives us a big opportunity. So if you pull this together, we're looking for deals which make these four, which tick at least 1 to 2 of these boxes. Right now, we've recovered all the cash that we had deployed for Max Protein, and that should be good for us. Further deals, largely, we will try to do without any external input. Will either be self-generating cash or debt.
Take that point. And finally, before we let you go, Tarun, what's the long-term aspiration of the company? 5,000 and 7,000 crore revenue by when?
That's mathematics. In a continuous basis, without accounting for any acquisitions, I think a good double-digit teens growth should take us 4 to 5 years. Add to some exciting acquisitions that we are evaluating most of the time, it could get much faster. But no specific time frame for me to share. Organically, we obviously have an inside plan, but could happen much faster if 1 or 2 of those deals really shape out.
All right, so the street will read that as 3 to 4 years, 5,000 crores is something that you get at with close to 17 to 18% margins. That's your aspiration. The funds which are buying into the company are hoping for that to happen as well. We take a short break, come back, get you more opinion on the market on CNBC-TV18. Stay with us.
Welcome back. Well, for the Bank Nifty is just about flat, trading with a little bit of a negative bias. But what seems to stand out today is definitely the mid-cap index, which is going from strength to strength. So up around 0.5% currently for the mid-cap index. And we have the advanced decline ratio as well, which is managing to stay on the positive side. So we have 2,300 stocks advancing to around 1,700 stocks declining on the Bombay Stock Exchange. Just keep your eye out on the small caps as well, because that is up around 0.7% at this point in time. So that's outperforming even the mid caps. Well, on that note, it's a wrap on Halftime Report. Stay tuned. Business Lunch up next.